Welcome to the cutting edge of the financial markets. This is JMSKULLZ Trading, where data meets discipline and precision. Get ready for a high-octane journey into market mastery. We build our structures on solid strategy and real-time analysis. Before we proceed, a vital reminder. Trading is a high-risk endeavor. Our content is strictly for educational purposes only. Trade responsibly. Never risk capital you cannot afford to lose. Always prioritize protecting your portfolio. Now let's watch the strategy unfold in the heat of the market simulation. From demand zones to structural shifts, we track every candle with surgical precision. Witness the power of a proven system as we hit our targets and secure the profit. Precision execution leads to consistent results. That is the JMSKULLZ way. Join a legacy of 5 years in the markets. It's time to level up your game. JMSKULLZ Trading. Learn, trade, and grow. Check out the link in our bio to start your journey today.
I just see the face. It says JMSKULLZ. Now, as you would have heard in my intro, that I would have been trading for 5 years, and within that 5 years, I do believe that I would have gathered enough knowledge to actually share back to the world itself, and hence why I hence created this trading course. But in this trading course, I am not going to be outlining any strategies that you'll be actually using in the market. I am strictly speaking on price action. Price action is based on the language of trading. If we understand the language of trading, just like how we understand English, Patois, Spanish, French, and all the others, we will better understand how our strategies can work in the market itself. So as I said, it's strictly price action. Now giving you a strategy, just outlining the things that we are supposed to be mindful for in the market, so we can get profitable strategies from this. So without further ado, let's go into it. Now we're gonna cover a lot of things in this course, and first I'm gonna give you a brief introduction of trading, how to start trading, time frame correlations, candlesticks, price action. And in price action, we have a lot of things to cover, such as market structure, support and resistance, supply and demand, the breakout of structure, change of character, market structure shift, order blocks, mitigation blocks, and fair value gaps. All right. So we have a lot to go through, so we're just gonna dive right into it. Now, what is trading? Trading is the act of buying and selling financial assets with the goal of profiting price change. These assets include stocks, forex, crypto, commodities, and derived indices. And for me, I am a derived trader who mostly trade the synthetic markets such as the VIX. I currently trade gold and not oftentimes trade forex, but I do when it's available. Right? Now, before even doing anything or touching the chart, you have to establish what type of trader you want to be and what works for you best. Right? Now, for me, I am a day trader. I believe that this works for me best. Why? And for most Jamaicans, you'll realize that they'll stick to the day trading. Why? We're impatient, and that is one. And day trading is where we can actually take a single trade within a day. Right? So that's what most persons want. And a swing trader is a person who actually holds a trade for more than a day and even up to a week. And most Jamaicans aren't going to want to hold a trade that long unless millions are come out and it. And then the long-term traders who are trading within stocks, such as companies such as Google and all of those stuff, Tesla's for over 5 years to see major increment on their investments. Right? No, after finding out what type of trader you are, there are specific time frames that you have to actually align yourself with to get a better understanding of how to enter and your risk tolerance. Right? Now, For long-term traders, they mostly stick from within the monthly, weekly, and daily charts. So they scan within the monthly to find higher time frame direction, the weekly to find the structural bias, and the daily to find their entry. Right? For swing traders, they use their daily 4 hour and 1 hour daily for higher time frame direction, 4 hour for structural bias, and 1 hour for entry. And for day traders mostly use some even use the 4 hour tool, but for minor trades like these, they use the 1 hour, 15 minute, 10 minute, and for the structural, and the 5 and 1 for the entry. And for scalping traders, that are persons who are actually scalping for a short period. So they normally use the 15 minute as their high time frame direction, the 3 minute for the structural bias, and the 1 minute for the entry. Alright. So in aligning yourself to what kind of trader you are, you can then align yourself with the different time frames that you're supposed to view in order to get a proper understanding of the price action. So how to actually start trading. This link will be provided in below the video in the descriptions area. So as you click on it, you will be then carried to the derived platform for those who are in Jamaica and those who have the accessibility to the platform itself. So you can just click on the link and sign up for yourself. All right. Now let's continue. So in this section now, we're gonna dive into price action in full depth. And in price action, we have a lot to cover, such as candlesticks, market structure, and support and resistance, supply and demand, breaker structure, change the character, market structure, shift order blocks, mitigation blocks, and even flavor. So we just have to move fast because we don't want to make this video too long. Now with candlesticks, we have to understand that candlesticks is a visual representation of financial assets price movement during a specific time frame. Now, one candlestick can represent a minute, an hour, a day, and a week. And this is where you would actually move along the different time frames. So this is where time frame actually comes in. So that is why aligning yourself with a time frame is very important. So candlesticks, we have two different types of candlesticks, which is the bullish and the bearish. The bullish candlestick is an upward movement candlestick where price starts at the lowest point and closes at the high, right? And on the bearish, we have price closing starting at the high and closing at the low, carrying price downward. So bullish is a bullish candlesticks carries price up or the market down. Right? So understanding this, we then understand what direction price is actually moving at a current moment. So here we have a lot of candlestick patterns, and candlestick patterns are good, but for me, I prefer to mark out the hammer, the doji, the bullish hamarami, morning star, and the M formation, head and shoulder, and double patterns, right? I love all these patterns because these repeat itself daily, even hourly, right? So these are patterns that often repeat itself in the market. Right? So in finding out and understanding trading, you'll realize these patterns actually formulating themselves more often in the market in front of you and can give you a good bias to where price is actually going. So after doing that now, after understanding what candles are, what they do, what they look like, we have to understand what movements they make. And with what movements they make, we have to talk about impulsive price movement. Now, what is an impulsive leg? Now, an impulsive leg is a strong aggressive price movement in one direction that shows clear market momentum and dominance from either buyers or sellers. In simple terms, an impulse leg is an expansion phase of price where one side of the market overwhelms the other, causing rapid movement and often creating a break of structure. Now, an impulsive leg. We have two different types of impulsive leg, which is the bullish impulsive leg, where we have multiple bullish candles pushing price to the upside. And on the reverse end, we have the bearish impulsive leg, where we have a lot of bearish candles pushing price to the downward side. So understanding this, a bullish impulsive leg is where bullish candles are pushing price upwards, and bearish impulsive legs is where bearish candles are pushing price to the downward side. Now, understanding these two in more detail, a bullish impulsive leg is a strong upward price movement where buyers aggressively take control of the market and push price higher. It shows that demand exceeds supply. And demand is when persons want a product from you. So therefore you're buying more products to actually supply. Good. And for the bearish, now we have a bearish impulsive leg is a strong downward price movement where sellers aggressively take control and push the price lower. So therefore, you have now bought up a lot of units, and now the market is now requesting it back from you. So you're not selling it back, pushing price down to the downside. And once you are selling a product and more of it is in the market, it is now common, hence the price of it falls. So if we understand business terminologies as well, it will also help us in our trading endeavors. So with understanding impulsive legs, we must understand a corrective impulse. Now, a corrective impulse in trading is a temporary price movement against the main trend and retrace part of a previous impulsive move before the original trend potentially continues. Now, in another sense, we have an impulse leg, right? A strong movement. Now, a corrective leg is a small retracement, right? Or a small corrective phase where price, for instance, if we're in a buying trend, if you're buying products, would you want to buy an item at its highest price or would you want to buy it at its lowest? So that's why the corrective phase carries price back to its lowest discount price, where you can then buy more units once more. And in the bearish impulsive corrective wave, in that manner would have been where you're selling out a lot of products, and what you realize that if you sell out a lot of products at the lower prices, you're gonna lose initially or in total. So what you do is buy the price up to get back price to a higher level, because you cannot fool the market with too many units to overcome the item itself. So you buy back products to carry back up the price. Then you're able to sell at a higher price once more. So if you look at the market structure on the left hand side, you can see that we have impulsive legs pushing price up to the first higher high, the first one. Impulse, the corrective leg carrying us to the first higher low. Then another impulsive leg carrying us. Then another corrective one carrying us back to the second low, higher low. And impulsive leg continues as we go. And the idea, as we're saying, price went up here, we catch the discount, buy again. While on the bearish side, we have price falling, retracing back with a corrective leg at the premium where you can buy, where you can then sell once more. All right, so that's the whole idealist on and trend itself. So this surrounds trends and market movements. So let's move on to price action. So price action Price action trading is the method of analyzing and trading financial market by studying price movement themselves without relying primarily on the technical indicators. And before, as I said, price action is basically the language of trading. If you understand the language of trading, trading becomes easy. Now, instead of using tools such as the moving average, RSI, and MACD to predict market price action, traders focus on the information contained within the chart, including candlestick patterns, market structure, support and resistance, supply and demands, liquidity areas, trend directions, price reaction at key levels. In simple, price action is a study of how price behaves and the use of that behavior to make trading decisions. Now, as I said, it's the language. It's just the language of how trading actually takes place. And understanding the language will boost your day. Now, the foundation of price action, right? Every price movement is created by an interaction between buyers, which is demand, sellers, who are suppliers, institutional participants, and retail traders, market sentiments. All right. Now, the main components of price action is market structure, candlestick analysis, support and resistance, supply and demand, liquidity analysis, price patterns, and formations, right? But in this course, I'm not going to touch on liquidity. I'm going to do another video on that so you guys can have a clear understanding. I don't want to pack this video with so much information, all right? So why is price action important? I can speak more on how important this is because, as I said, price action is basically the language of trading. It teaches you everything in market structure, liquidity, order flow, supply and demand, institutional zones, and it also gives you an insight of how emotional traders actually trade, right? And where emotional traders are most likely to enter a trade, right? So market structure. So the first thing we're going to talk on is market structure. What is market structure? Market structure is the way price moves and organize themselves over time. It is the framework traders use to understand the behavior of buyers and sellers by analyzing the sequence of price highs and lows. And every market is consistently creating a structure based on supply and demand. As buyers and sellers compete, price forms recognizable patterns that reveals whether the market is trending upwards, trending downwards, moving sideways, or preparing for potential reversal. So as you can see, price action is definitely and so heartedly tied to market structure because the language must also have its interpreter, the person that actually shows itself to its personnel who it wants to teach the language, right? And this image in itself is a whole example of what market structure is all about. We have upward trends, we have ranging trend, ranging are consolidating, and we have downward trends, right? These are the three forms of market structure that you often see in the market: upward trend, sideways trend, and a downward trend. Now, market structure is the foundation of price action, as I said, right? It's foundation. Instead of using other tools, price action is what you first see. As you open your charts, the first thing you'll see is candles or a line. And if you can't understand what the line and the candles are saying to you, trading becomes very, very difficult. Now, the fundamental concepts of market structures that I like to speak on in this course is support and resistance, supply and demand, breaker structure, change of character, market structure shift, order blocks, and mitigation blocks, and finally fair value gaps. Right? Now, go straight into it. So support and resistance. Support is a price level or area where buying pressure is strong enough to prevent the price from moving lower. It represents an area where buyers become more aggressive than sellers, creating demand that pushes the price upward. So hence why it's support areas pushes price up. Hence the word support. It's helping us upwards, right? While resistance is a price level or area where selling pressure is strong enough to prevent the price from moving higher. It represents an era where sellers become more aggressive than buyers, creating supply that pushes the price down. So it is inverse of support, so that would have been our roof. So normally we have our floor to support us upwards and our roof to resist uh, us from jumping higher than we're out to and so forth. Right? So that's a little analogy to help with the support and resistance. Now, support is where demand overwhelms supply, preventing price from falling. Resistance is where supply overwhelms demand. And the psychology, just as I just stated. Now, here is a illustration of support and resistance. Now, the support area, as you can see, is highlighted with the green area at the support area at the bottom here. So we have 1, 2, 3 touches where price came down into the area but was not able to break the area. Hence why it went back to the upside. And to the upside, we then have recognized that we also have a resistant zone where it has also touched twice, well, not twice, 3 times, and it was able to hold price where it then pushed price to its ultimate low on the last touch. So this is a example of support and resistance, and not in every case support and resistance will be as clean as this. All right. And before I even move on, once this support level has now been broken, it is now going to be considered a resistance level, right? Because support is now turned into resistance. And that is one thing we need to understand. So if in this case support was broken, so support is now going to turn resistance for price going down. While as if price had broke on the upside, the resistance would have then become some support zone, which will then help to push price higher. All right. Now the next thing that we need to cover is supply and demand. And supply and demand is tied with support and resistance, but sometimes due to the wording, it is hard to understand which is which. But supply, what is supply? Supply is the amount of selling pressure available in a market at a specific price area. A supply zone is an area where sellers become more aggressive than buyers, causing price to move downwards. When there is a large amount of supply, there are more sellers willing to sell than buyers willing to purchase. This imbalance pushes the price lower. Now, understanding supply, we're just supplying persons with goods. We're selling out our goods, right? Selling out. Why we not sell out in Jamaica still isn't, but we are selling out the goods there, is it? Now, what is demand? Demand is the amount of buying pressure available in a market at a specific level. A demand zone is an area where buyers become more aggressive than sellers, causing the price to move upwards. When demand is strong, there are more buyers willing to purchase than sellers willing to sell. This imbalance pushes the price higher. So when persons demand a product from you, they have to go buy the product. So they not buy out the product, them boss. So basically when they're demanding products, they're gonna buy the products from you. Right? Simple. No, In an upward trend, you will realize that there are more demand zones created at a higher level as you progress in a upward trend. And until one of those demand zones have been broken, no supply zone is valid as yet. All right, that is one thing that we must understand. So until one of these demand zones are broken, a valid supply zone is not created. So that's a little to understand on trends. And in the bearish trend, we have supply zones being created lower and lower as we go down. So here we have a supply being created here, which is the first, the second one, and with the second one, we recognize that price had retraced to this era before continuing to create its third supply era, which also created, it was used as a retest point to push price lower. So demand areas in the upward trend can be used as a retest area to push price higher, while supply areas can be used as a retest area to push price lower in a bullish market. So just be mindful of these. So that's why supply and demand is so important. All right. So breaker structure. A breaker structure is a price action event in which the market breached a significant previous high or low, confirming that the current market direction is likely to continue. In simple terms, a breaker structure occurs when the price successfully breaks an important swing point, showing that one side of the market has gained control. Breaker structure is very important because it helps us to understand who is in control of the market. And once we understand who is in control of the market, the trading bias and our trading decisions will be easier to be made. Right? Now with breaker structure, not every break of a high or low is valid. A valid breaker structure usually requires a significant swing point. The broken element should be meaningful, such as a major swing high or low, a previous trend defining point, higher time frame level. Small random fluctuations are not always breaker structures. So we have to also be mindful of that. Key takeaway: a breaker structure is a confirmation that price broken a meaningful swing higher low, showing that buyers or sellers have gained control. A bullish breaker structure, price breaks a previous high, buyers showing strength. And while a bearish breaker structure, we have price breaking a previous low, showing that sellers are in control. Right? So as I said, breaker structure helps us to understand who is definitely in control of the market. And here we have a bullish breaker structure example where price is breaking our highs and continuously moving to the upside each time. And we also have a bearish breaker structure example here where our lower lows are being broken each time by price, pushing price low. So understanding breaker structure helps us to understand the actual structural bias of the market. And as you would have seen previously, this would have given us an example of how market actually looks when it is trending up and breaking structures, while as it's trending down and breaking structures to the lower side. So here we move on to the change of character. Now, change of character is one of the most important things I would like to highlight in this course. It and the next topic that comes up after this. And this is where most traders have a problem because when they understand what change of character is, they will understand why their trades aren't actually playing out in the way it ought to. Alright? Because they are seeing this and not understanding that yes, price is actually telling you that I'm not going down there, I'm not going up there. But you still stay in the trade. No, a change of character. A change of character is a market structure event that signals a potential shift in control between buyers and sellers. It occurs when the price breaks an important structural level against the current trend, suggesting that the existing market direction may be weakening and a possible reversal could develop. As I said, a possible reversal could be developing on you, and you're thinking that, oh, this trade is continuing. So sometimes we have to actually take the warnings when they're actually being given to us, and understanding what are the warnings in trading is understanding change of character. So in simple put, a change of character is the first warning sign that market makes to transition from one direction to another. Unlike a breaker structure, which usually confirms continuation, a change of character often signals a possible change in market behavior. So we have to be mindful of the warnings that price action itself gives us, right? Which is change of characters. No, we have bullish change of characters. A bullish change of character occurs when the market changes from a bearish structure to a bullish structure. It occurs when the price breaks above the previous lows high. This indicates sellers are losing control, buyers are becoming stronger. A potential bullish reversal may be forming. Whereas we have the bearish change of character. Now, it would have been the reverse of the bullish to say that bearish change of character occurs when the market changes from bullish structure to a bearish structure. It happens when the price breaks below a previous higher low. This indicates that buyers are losing control, sellers are getting stronger, and a potential bearish reversal may be forming. All right. Now, the key takeaway to this, once we see the warning, we can understand that probably our trade is not going to play out in the way it ought to. All right, these are warnings. This is a warning, right, to show that yes, price may not go any further. So when we see these warnings, we have to take heed. All right. Now, a bullish change of character, we recognize that we have, if we can see a breaker structure happening to the downside, another breaker structure. But what do we recognize next? Instead of pricing pushing lower, it then pushed higher, breaking our last swing, our high point, our swing high. Yeah, our swing high point. Once that has happened now, that is our warning. That is our change of character. That is our first indication that the price is going to change. And that's what we call change of character. Now, after that change of character, I said earlier in the video that only if a swing point is broken, then the reversal would then appear in terms of supply and demand. Now, if price was pushing downwards, that means price was creating more and more supply zones. This would have been a supply zone that would have then been broken. Now, if a supply zone is then broken, obviously a demand zone, a valid demand zone will appear. And when price retests into that demand zone, that's the second confirmation to say that yes, once we see a rejection in the demand zone, we know that price is definitely going to change and carry us into a bullish market where we're going to see another breaker structure pushing price to the upward side. Right? So that is a change of character from a bullish standpoint. Now we're going to look at it from a bearish standpoint. Now, here we have price pushing upwards, creating breaker structures, two breaker structures, but instead of breaking structure once more, what did price do? It swept and passed the last swing low, where our demand zone would have been formed, right? And after breaking that demand zone with a change of character, the inverse of the demand zone will then appear, which will then be valid, which is a supply zone. Now, this supply zone will be our second confirmation to confirm whether or not price is actually going to continue downwards. All right. So we have to see the rejection in the supply zone to confirm that price will then give us another breaker structure to the downside to bring price further down. All right. So this is change of character in its entirety. All right. So I hope you understand that. No, market structure shift. Market structure shift is the second warning that we get for reversal. Most persons don't understand it, and I understand why, because there's a long fluctuation of price movement before the structure has actually shifted. So, worse, as Jamaicans, we're impatient, so we don't want to sit there and watch prices moving sideways for a long period of time before it actually makes a decisional move, right? So a market structure shift is a significant change in price behavior of price that indicates that a transition in market control from one side, buyers or sellers, to another. It occurs when the price breaks an important structural level with strong momentum, often after a liquidity event, showing that the previous market direction may no longer be valid. No. In simple, put a market structure shift is when price change from one structural pattern to another, signaling that a new trend or direction bias may be forming. And market structure shift is commonly used by price action and liquidity traders to identify early reversal opportunities. Alright, so as I said, this is a second confirmation to understand when price is actually going to reverse, right? And as you know, with our change of character, we must have a bullish and bearish. And for our market structure shift, we also have a bullish and bearish market structure shift. So our bullish market structure shift will first start out. We're gonna have a breaker structure pushing price to the downside, two breaker structures, and then what do we recognize? Price rallies for a second, then pushes price back up to break our swing high, which is now going to represent our market structure shift. So price would have taken a while, consolidated for a while, then it would have shifted the market in total to create a market structure shift. And as change of character and market structure shift, they're similar in a sense. Once we would have broken a supply zone, we know then a valid demand zone must be formed, right? So that's where the retracement would have happened here to push price up to give our breaker structure pushing price to the upside, right? And in our bearish scenario, we have price pushing upwards, making breaker structure, and then rallying for a second, then breaking a significant swing low point, creating a market structure shift. And because this break is not as clean as how I would want it, I will wait for a retest of a supply zone in this area first before I would confirm for my breaker structure to push price down to the downside. Okay? And as I said, market is not going to be as clean as this, although it has a lot of choppiness in it. Price is more unpredictable on how it looks. But once you understand the structure in itself, you'll be profitable. Alright. Now the next thing that we want to target is order blocks. Now an order block is a price area where large institutional traders are believed to have placed significant buy or sell orders before a strong market move. Alright. In simple put, an order block is a last area of buying or selling action before a major price expansion or market structure change. Price often returns to these areas before not all institutional orders may have been filled during the initial move. When the price revisits the zone, remaining orders can create another reaction. Order blocks are commonly used in smart money concepts and liquidity-based trading to identify potential entry areas. All right. And our order blocks can also, as I said, understanding price action. Price action is tied with a lot of things, a lot of concepts are tied. Supply and demand zones are tied with order blocks, and understanding that you'll also understand that if supply and demands are tied with order blocks, that means support and resistance areas are going to also have order blocks sitting there with supply and demand zones. All right. So just to tie in everything about trading thus far. Now, order blocks are at the initial stage of the impulsive leg. Now, in this case, we have a bullish market price being pushed to the upside. So our order block in this case, in this first scenario, would be the first candle before price push upwards. So these two candles I will use as my order block, and also it can be represented by demand zones. So as we go up, we realize that we have another order block here on the next impulsive leg. On our next impulsive leg here, we have another order block, and it is also used as a retrace area to push price upwards. And here we now have another order block being created off that retracing area that also help to push price upwards once more. So the key takeaway is order blocks is a significant price area where institutional buyers or seller activity occurs before a strong move. So this is where strong moves are likely to happen. This is where your eyes should be focused mainly on order blocks. And order blocks can also be formed or what we know as inside candles. Inside candles are the bomb. They are the bomb. Alright. Next thing that I like to talk about is mitigation blocks. Mitigation blocks for me is just a place where institutional uh, participants come back to fill orders, such as order blocks as well. So it is normally mitigated. A mitigation block is a price action where unfilled or partially filled institutional orders are revisited before the price continues in the intended direction. The idea behind mitigation is the large traders may not be able to execute their full position during the first move. And as you can see, this is simply tied into order blocks as well, right? So they are so similar. So that is why I had to highlight both of them. All right. Now, there's a comparison between them. The area where institutional orders are initially placed, the same thing. Institutions return to manage their positions, right? So institutions are often looking at order blocks and mitigation, uh, often appear before a strong move, and as you can see, appears when price retreats after a move. So it retraces to that strong move, right? So you can see how they're so tied. And mitigation blocks for me are these areas. As you can see, there would have been two blocks there. And in this large mitigation area, you recognize that price actually came here to retrace back into it and actually push higher. Now, as you can see that a lot of the concepts are tied because as you can see in where our first illustration on order blocks where the order blocks sat there and also form a retracement area for price to push up. And if you now look at mitigation blocks, it also created an entire zone or area where price could have came back to actually then develop the urge to push higher. So you can see how these concepts are tied a lot. Now, the final thing that I would like to speak on is fair value gaps. Fair value gaps is, for me, is one of the things that let me understand price a little bit more, because fair value gaps are three imbalances in the market that price must cause an equilibrium covered. Right? Imbalances must be covered. There must be an equilibrium in the market itself, right? So, with that being said, fair value gaps helps us to spot imbalances in the market more efficiently. Alright. No, I was not a lover of the fair value gap at all, but it has happened to grow on me, and I come to appreciate it. No, a fair value gap is the gap between the high and low of three consecutive candles, where the middle candle moves strongly and leaves an imbalance, I should say. It usually forms during strong momentum moves. How to identify a fair value gap? Look at three candles. Bullish fair value gap. Number one is a normal candle. The second candle is a large bullish impulsive candle. And the third is another candle that continues upwards. A gap formed between the high of the first candle and the low of the third candle. And I will show you an example. Now, we must understand too that not all fair value gaps are valid, and we have to understand that. Alright? But before going into that, let's just highlight the fair value gaps that are valid. Now, here's a valid fair value gap. We have three candle patterns pushing price in the same direction, and that is something that is very important. The three candles must be going in the same direction. They must be of the same intent for that fair value gap to be valid. Here we have another three candle pattern, fair value gap, valid fair value gap, three candles going in the same direction. Here we have another, and you can see that price came back here to retest. You can see that this zone is a high zone of confluence to actually buy from. And if you would have been watching the video, you will realize that every time price came here, there was something in this area to push price higher. Alright, so here we have a fair value gap, here another one. Alright, now these are all of the fair value gaps. And before we end the video, I must speak on the fair value gaps that are not valid. For example, the one that you're seeing here where my cursor is, we have a three candle pattern, but we recognize that the three candles are not going in a specific direction. They don't have a single intent bias. Alright, so this is an example of a non-valid fair value gap. And I would like to thank you for sticking around with me, for watching the video, and stick around. There are gonna be more videos coming to you. Alright, thank you so much. Have a wonderful day. Goodbye.